Welcome everyone. This is Mark Monfort here for FEX Insights, and we're here with a very special guest. It's Brian, the director of FEX. How are you?
I'm good.
We're here in the great and awesome FEX studios here at Bridge Street. We've been filming a few podcasts from here while you guys work out way upstairs. So first of all, thank you for the space. And I just wanted to talk to you about something that's been really important that we're seeing overseas and a lot of people talking about, and it's the topic of prediction markets. So let's just get straight into it. What are prediction markets for the folks that maybe don't know?
Well, can I just back up a little bit
Please.
and give you a little bit of my background, only because it is relevant to the topic. So normally I don't need to go into my background, but
Yeah.
I think there's a lot of people talking about prediction markets, in inverted commas, that have no real background in either derivatives or wagering or whatever, who have just found out there's a new word to throw around.
So can you tell me a bit more about your background?
Yeah.
Because you're right, like people need to understand like there's a reason for all of this, and I want to hear more about it.
Yeah, okay. So it'll be a little bit detailed, but I think it's important that people in the space I want somebody that gets some value out of spending time listening to this. And I think if they know where you're coming from, it helps them give perspective to what you're talking about. So that's the purpose for that. So I began trading, in inverted commas, when I was 13.
Wow.
So I was doing a paper route in Canada, and I was delivering the Toronto Globe and Mail, and there were financial pages, and I used to sit with the truckies in the morning at about 4:30 a.m. before I delivered my papers, particularly on really cold days when it's freezing cold. And I then came home and I forced my mother to open up a trading account, because I went to the stockbroker on my own. They wouldn't let me open an account. So she came, and it was called Richardson and Wrench, and it was in London, Ontario, Canada. And I bought my first share there, which was a company called Payto Oils. And this was in 1973, late 72, actually. And that went really well because of the oil crisis that was happening, the OPEC, the cartel that was forming over there. And that share went up magnificently. I think I made about $4,000 out of it. And this is when I'm 12, so it's good money.
It's a good start.
Then we went back to the stockbroker, and he said, don't fall in love with the stock. I thought, okay, that's a good thing. So he got me to sell that. And then he said, you got to get into some blue chip. So I got into Glendale Mobile Homes, which was a big mobile home seller. Oil prices went up. They went bankrupt. So I lost all my money. That was my first foray into the market. Then I started trading futures when I was 15. So I was trading cattle and wool and gold futures at that time. And that was, and I did that for about, that was through a broker in Sydney, in Australia, actually, which was Darlington Commodities.
Okay.
And I did that whilst I was finished off school and went to university.
In Australia.
Yeah. I went to New South Wales University. I did a Bachelor of Commerce in accounting and then a master's degree in tax and finance. And when I came out of there, because of the Paul Keating had opened up Australia for overseas banks, there were jobs galore for anybody who had come out of university who was who was 23 with degrees. So, but I ended up getting a job at a company called Trans-City Holdings, which was an official dealer, which meant we're official interest rate dealer. We're a subsidiary of the Bank of New York, and we were really small division of 7 at the time, actually, but we're really, really heavily involved in structured products. We did the first swaptions in the world. We're one of the top 4, us, BT, Macquarie Bank, and a Chicago Connor Partners in Chicago. And during that time, we did everything. We were market makers in interest rate swaps. We did the first caps and collars. We structured up huge OTC transactions for corporates in Australia, large corporates, the biggest actually in Australia. We made markets on the trading floor. We ran a dealing room and a trading floor operation to arbitrage against so we built OTC products based on hedging in futures. We did, in those days, we spent a lot of time walking around with log tables in our hands because there was none of this, you couldn't go to Claude and build a bot or anything. So we built all those programs ourselves.
Yeah.
We're global market makers. We, I guess there was a book called Cox and Rubenstein about options, and that back there was sort of the main thing to learn about it. But we actually,
survival.
Yeah, but we wrote we wrote papers ourselves for the corporates to read and try and learn about it. So we're really heavily involved in that. And then we had not a little bit, we had a bit of a disaster in 1987 because we were really short volatility and we didn't understand anything about markets gapping or, the program trading that allegedly Prudential caused the 87 crash. So we really learned about a lot of stuff during them about gaps in markets and how volatile the market can be and how you can't get out. And especially, particularly if you're using leverage, you can just get squeezed right out. The exchanges can increase margin with no notice. You've got to pay margin calls real time. I think we paid the biggest margin call ever in Australia at the time.
Really?
Ran down to the clearinghouse with a check.
Jeez.
In the old days. That would have been,
Yep.
So that was interesting. Then in 1987, I went out with a proprietary trading company where I did it with a smaller group, and we did index arbitrage. We did interest rate arbitrage around the world. We did Japanese government bond futures arbitraging life in Osaka. We did the Bund, the German Bund, the French Nationals, the Gilt, the Italian BTPs. We were trading the S&P 500. We're trading the DAX. We're arbitraging. And I'm going into this a lot because this is the genesis of where all this comes from.
Yeah.
This is how these markets, this is the learnings that people had all the way through to where we are in 2026. So this isn't a 2020 prediction market, it's on a 2026 market. They go all the way back, I think 1865 when the CBOT opened. Options have been around for over 50 years. Options were listed here in Australia, I think in 1984, and I think they're on CBOT, I think in 1976. So there's nothing new about options. There's nothing new about futures. There's nothing new about derivatives. There's nothing new about problems, compliance, surveillance. So, and we went through everything. We went through LTCM collapse. We went through
worth looking up.
Nick Gleason. We looked through Metallgesellschaft. We looked through, and even so, all that stuff was happening during that period of time.
There's some good movies, but like the Nick Leeson one, there's a great movie with Ewan McGregor was the one in there. You were talking about futures and trading commodities. Trading Places is a great movie.
It's not.
There's this history.
It's more realistic than people think. It's not that much, but it's quite realistic,
which is fascinating.
Yeah. So I actually was on the trading floor for 14 years in the open current trading floor because I sort of preferred market making that environment because it's just a bit more. It was brutally active, which I quite liked. Then I did that for about 20 years. Then in 2006, I decided to set up a futures exchange, which was to go end to end. And that's not going on Claude and copying other people. We wrote operating rules, procedures, compliance, surveillance, tech, every single thing from scratch. Taking a pen out. Nobody at that time had ever applied for a license in Australia.
All right.
ASX had theirs grandfathered to them. So we had to start absolutely from scratch. We did everything.
Wow.
Started with one person. So we are intimately involved with how to actually write rules, settle products, settlement price, every single thing. If anybody listening to this is in the derivatives industry, whether you be at a DCO or a clearing organization or a DCM or a market license or an FCM or a broker, you will have encountered some of these issues. We had to do them all. Wow. We onboarded, we offboarded. We're also the first ones in the world to do a horizontally integrated DCM, DCO model where you had clearing outsourced into a different jurisdiction and cleared by a different organization, which is obviously very complex. We wrote everything to do with that. All the pre-trade risk things that were important to that, onboarding the ISVs, everything. And this was back in the 2013, 14, 15, 16. So this was, none of the stuff's available. Most of it wasn't even on the web. You had to go and hard onboard TT and people like that. So I've also got past my NFA Series 3 exam in the US. And we've I've been the director of a swap execution facility, which we developed. We wrote we did everything for that, including our own internal clearing, the default waterfall, the default fund, and I know I'm going on about it, but this is about what the industry is. This is what prediction markets, these are the pillars of prediction markets.
Yeah.
So this is why I want to talk about this, even though it might sort of feel like I'm going on and on about it. But
there's a lot for people to look into that are new.
There's a huge, it's like an iceberg. Beneath so-called prediction market, there's a huge iceberg below it. And that's what's the important part of people saying, I'm going to start a prediction market. It's not like that.
Not so straightforward.
And then if you look at the wagering side, I've also got extensive experience in how a bookmaker wagering operation works, including being involved in the application for a license, the risk management, everything to do with client servicing, all the rules that Australia's put in place in terms of ranging from bet stop to advertising, through segregation of client accounts, through every type of thing that's required to be done in wagering. I've brought here today the Interactive Gaming Act and the Corporations Law and the Market Integrity Rules, because in Australia, wagering is covered under the IGA, it's an Interactive Gaming Act, and ACMA is like the ASIC in. So I know a lot about the wagering business, a lot about the licenses, what they're allowed to do, and basically the whole operation of a wagering business. I understand that intimately.
Yeah.
So there's the background as to how I come to talk about prediction market.
Brilliant.
So the wagering company that I'm working with, they do 60,000 events a day. So they're setting and settling 60,000 events. So they're incredible. These wagering companies are incredible organizations, incredible amounts of IP, but completely different from the derivatives market structure on the derivative side. So that's I guess the background to where I'm coming from. Now, what I'd like for, at the end of this podcast, I'd like to, the whole purpose, just give people a little bit of different perspective, empower them with a little bit more information if they're arguing a case or they want to chat about it more. At least it sets a conversation about what a prediction market is.
Yeah, it's not something new. It is. Maybe there's a new way of looking at markets, it's new technology involved, but the pillars, the foundations is still the same.
Correct. Okay. In fact, they're actually simpler because currently they're fully collateralized, which basically means that the participant, the user of the account, actually fully funds their trade, unlike a margined trade that has to be continuously monitored with minimum margin requirements and initial trade requirements for margining. So it's a much, much more simpler model than traditional derivatives.
All right, so we've got a really good background on, the work that you've done, the experience that you've had. I think there's a lot to look into there for anyone that is watching, but let's just go back to where we're at today. What would you say are prediction markets?
So to me, there's no definition yet for a prediction market. Okay. So let's talk about the 2026 accepted definition. If somebody goes onto Wikipedia or Google or something, how it's going to come across to them, and what they're going to say is something about it's a aggregation platform which aggregates people's opinions on event outcomes, and those opinions are reflected in percentages. So what will happen for example, if it might be let's just look to a sporting, it might be Tottenham playing Chelsea in the English Premier League. And let's just say Chelsea's a favorite. They might trade at 68 cents. Someone's got to deposit 68 cents. The other party puts in 32 cents. It goes into more or less a central pool of custody. And the winner, the trade outcome, who gets it right, gets the dollar back, less the brokerage. There's a central order book. So it's unlike in a wagering company where the client is a price taker and the wagering company is a price maker with an inbuilt spread. The central order book aspect of a prediction market means that the retail participants or any participant is coming in and trading against another participant. So that's really what a prediction market is. They've been around. There's lots of interesting things that people want to research prediction markets. There's really controversial back in, I think, 2003, DARPA. If people are familiar with that, so I think the Defense Research Organization in the US, they thought it would be a fantastic idea to have prediction markets over, predict whether this could be a war or a coup. And then both sides of the government in the US shut that down, saying it's immoral and all sorts of reasons why it didn't happen. But really, so the 2026 definition is a binary payout on an outcome where people get a contract size of $1. That's how I'm going to describe it. Now, those outcomes can be based on you can pretty well make up anything if you want. You can have an outcome based on anything. So you can say the outcome of whether I'm going to trip over today or whether, the sun's going to come out at between 12 and 1. But really, they're extraordinarily practical for economic outcomes because it means that people can really target what they think their skill set is. So instead of, let's look at the RBA raising rates. Historically, what we normally do is say, okay, if rates are raised, the Australian dollar might get stronger, X, Y, and Z might happen, but you don't know if it's really going to happen. But you have a really, really strong view that the RBA is going to raise rates. Well, I would want to do a trade based on that one view, not something else that can be interrupted by tariffs or some other extraneous thing that comes into that trade. So that's where I think that's my definition what a prediction market is.
So people can bring their expertise into it. There's a lot more. And the interesting thing, coming from a background of being in the blockchain space, we've seen overseas in the US and I guess like other countries where this is more available, that retail traders have like moved to this because there's more real outcomes rather than, okay, you buy into a blockchain project or crypto project and you hope that something happens from that, but it's not guaranteed. So I think it's been interesting seeing people move to that, and that's why I guess it's been in the news. What do you think about that? Like prediction markets have been in the news a lot. What are your thoughts on all of that kind of stuff?
That's a good question. So they're in the news largely for three reasons. This is my opinion, obviously. This massive expansion of this idea of insider trading. This is just incredible. People are going to be knowing that it's just a mad, crazy circus of people trading. Well, it's in the news for that reason. But if you look to our market structure, the derivatives market structure that's been around nearly for 200 years, surveillance and compliance and chasing down insider trading, we've been doing it for 150 years in our industry. It's not a big deal. This idea that that you can't surveil a market. What you have to do is make sure the outcomes that you're listing for trading have the ability to be surveilled to be compliant. So if it's whether Mark Monfort wants to wear a different colored shirt today, you can easily tell Chris, the videographer here, what it is, and he can do the outcome that he can. So that's something you wouldn't list. But something like an RBA interest rate move, it's readily discoverable. So the insider trading is more about the nature of the contract that you list. The other one that's been in the news is obviously prediction markets over assassinations or bombings. Now, they're already covered in our normal market structure. There's no way we would be allowed to list a product that was something to do with physically delivered uranium into Iran. So the market structures in the financial markets spectrum of society. We already know all these things. It's only coming to the news for that reason. The other reason, I think the biggest reason it's coming to the news, the most important reason, is that if people recall, it's only really 2018 that Americans have sort of been able to gamble, basically. Australia, we've been doing it since the Rum Corp, since the colonization of Australia. They've been trading.
You've had swap and all that kind of stuff.
So you've got the 2018. So you've got the global operators moving to the US. Massive potential revenue base. You've then got crypto at the same time, bringing customers in and trying to take on event markets. You've got the financialization of markets. So you've got the derivatives exchanges saying that, well, we should be doing this. And by the way, they're very well backed by the CFTC. So I've got a lot of clout from the federal government there. So you've got this convergence is fighting. It's mostly about sports, less so elections because of the revenue in sports. So you've got the states fighting, you've got the Fed fighting, you've got the derivative exchanges fighting, you've got the crypto exchanges fighting, you've got the equity exchanges now trying to do event contracts in equity style. It's just convergence of people fighting for this sports revenue. That's why it's in the news. And that's why there's court cases everywhere. Every day there's a new court case coming through. But ultimately, they're not in the news because of prediction market structures no good. They're in the news because people are fighting for what can be on these markets. And that's why they're in the news. There's nothing wrong per se with a prediction outcome contract.
We've been doing it for a while.
Correct.
Who are the biggest players in the space? If someone was like, is very new to this, like who are some of the names that come to mind there?
Well, the two names that obviously come to mind are Kalshi and Polymarket because they're in the news. Kalshi's making announcements nearly on a daily basis what they're going to be doing and things that are already being done on other exchanges and other sort of products. But they're the ones with the very large market caps. They're the ones that the traditional big investors are going into. You had ICE going to Polymarket. So they're the two big ones that everybody's thinking about. There's obviously other things happening. There's Robinhood and Susquehanna that bought the 90% of MyX. There's Electronix. There's ForecastX. There's Railbird. There's Binomial. There's everybody trying to come into the market. But the other two ones with the biggest market cap. So their combined market cap is over 50 billion Australian dollars. So that would put them in the top 20 companies here in Australia. The difference, though, is that they're entirely different market structures. So people use them in the same sentence, but they're nowhere near the same thing. Nowhere near the same thing.
How so?
Well, Kalshi is a DCM, designated contract market, with the DCO, with FCMs, futures commodity merchants, and everything that's established as a US derivatives market structure company within the United States, surveilled by the CFTC. Polymarket is a crypto-based prediction market. They're my understanding, they're Bermuda-based. They're trying to move into the US regulatory. My understanding is they're trying to do that right now. But they're entirely different. And Kalshi is the one that I would say is by far the more, I'd say, trustworthy model. Now, I know that ICE has just bought into Polymarket. Purportedly going to put $2 billion into it. Now, obviously, what they're going to try and do is Americanize and regulate, whatever the word is, turn Polymarket into a regulated entity. But that's going to be a big lift, and that's going to involve a lot of changes. So they're the two in the news, but they are entirely different market structures.
It's not just them. And I think that's interesting that they are coming from those like different backgrounds because people just see the headlines, think they're the same thing.
Correct.
Taking those two big players, what's the status of how they work, say, here in Australia?
Okay. It's a good question. So both Polymarket and Kalshi are illegal in Australia. And this is where I'm coming from. This is based on the Corporations Law, Interactive Gaming Act, and other aspects of Australian legislation. So if you're in Australia, if you're offering a derivative for sale in a marketplace, and a derivative is in the Corporations Law as described 761D. 761D says this is what a derivative is. And if you're offering or dealing a derivative, you need to have a AFSL at the very least, which is a section 911A, which is an AFSL to deal in the product, or a market license under 791A, an Australian market license to offer the derivative. And ASIC has a regulatory guide RG172, which explains what they would have to do to operate in Australia. And Kalshi, for example, would understand that, and obviously ICE would be a buyer into, so they would both understand those restrictions here. Then the other thing that needs to appreciate here is that there's a really complex, state, territory, and federal interacting gaming laws in Australia. So if they're saying, well, no, we're not derivatives, we're gambling, then they're covered by the Interactive Gaming Act. which was amended in 2019 to add some other features to it. And it's interesting to look at the fact that it was ACMA who warned Polymarket off Australia back in 2025, not ASIC.
Oh,
so they're the first ones to step in. So I guess
it's a downside.
5 stars ACMA.
Yeah,
I'm going to say that for sort of doing that. So they've got those hurdles. They've got that first hurdle, which is whether they're falling under the Corporations Act. They need the second hurdle if they're going to try and purport to be gambling contracts, and they have to have a appropriate gambling license to do that, noting that you can't have a central order book in gambling. So that's sort of one of the other things. And then if you look at ASICs, as far as the crypto side, ASIC in their Info 225, and they've done a 5 stars ASIC on doing it. They've done an incredibly good job on doing that.
Agreed.
Incredibly good job with all the pressure they've had to, that these are different, and everything's nearly, a financial product's a financial product.
Yeah.
And looking back 50 years ago when we developed them, or 40 years ago, there are financial products that nobody understood, but everybody in the end knows if it's got an economic purpose, it's a financial product. And if it's something settling in the future, it's a derivative.
Yeah.
Whether it's a financial product or not, it still becomes a financial product by being a derivative.
And Info 225, actually, ASIC didn't just say, here's the rule, just comply, but they actually had something where if you wanted to figure out how best to bring your product in, they had openings in Info 225. When we spoke to ASIC, I think it was
correct.
They were very forward thinking. They want to drive.
Yeah,
well, they don't want to stifle innovation.
Yeah, they did as far as I'm concerned, they did an extremely good job despite all the criticism they got for it, and supposedly being late. They did it right instead of early. Now, one of the things that is interesting as well is that you might get a Kalshi or a Polymarket using a term reverse solicitation. So they might say, well, we're not operating in Australia, but some Australian people came and joined our business. So therefore, how can we control that?
Yeah.
But we know very well that, and ASIC put out consultation paper 315, which pretty well said reverse solicitation is a very narrow window of protection, and any type of enticement whatsoever will knock out the reverse. So if you look at both Kalshi and Polymarket, they're both listing Australian AFL. They're both listing rugby league. They're listing even the Australian election, even the fair by-election coming up. So they're listing Australian products.
Yes.
They're not paying product fees to the sports bodies. They are using sports body logos over there. So that would just be, I assume Peter V'landys wouldn't be too happy about that, because here in Australia, if you're a wagering company, there's extensive documentation, and it's very intricate about what you can do and what you cannot do. They also pay product fees and taxes and turnover taxes. There's lots of different, and of course, Kalshi and Polymarket are avoiding those taxes by offering it. So I don't think they can get out of the reverse solicitation. So as far as I'm concerned, they're completely illegal here.
Okay. Oh, this is fascinating. You mentioned 761D and derivatives. If the Corporations Act is so clear on what is a derivative, then why don't wagering operators, say, fall foul of ASIC?
That's a really insightful question. And the reason for that's really nuanced. It's because there isn't, in the corporations law, they're not excluded from being derivatives.
Okay.
So they would be captured by 761D, and therefore obviously the 911A and 791A. But it seems to be, it's been a bit of a tinkering process from a regulatory point of view. So back in 2010, I think it was CenterBet and some of the wagering, they were offering wagering contracts in interest rates and share price index and a couple other things. I think they started doing it in the early 2007.
Wow. Okay.
But in 2010, ASIC went full, what would you say, put full court pressure on them to say that you guys, these can be construed as derivatives contracts, and we think they are, but we will exclude. So we ask you to take those down. Otherwise, you could potentially be in breach of criminal activity under the corporations law. So in 2010, they removed those. And then I think that they sort of had been a settling of our wagering companies aren't going to go after any of these products that might appear to be financial products. And that sort of went along sort of quite well until about 2016. And in 2016, somebody's obviously written to ASIC, one of the foreign gaming, said, we're coming to Australia. How are we not affected by this 761D, irrespective of the fact that they can't do economics? Really, they could be caught doing sport as well. So they wrote to ASIC, and ASIC came back and ASIC explained in their report 506 in December 2016, the reason for giving this particular wagering company an exemption. And this is really important for the whole prediction. It's sort of everything sort of rests on this for the whole prediction argument.
Okay.
So ASIC said back to them, they said in their 2016 report, they said that, where are we here? They considered that the wagering contract is capable of being described as a derivative. They said that.
Yep.
They then said that a wagering contract is not considered a financial product under the Corporations Act because it lacks the necessary financial purpose, regulatory intent, and community expectation of being a financial instrument, and therefore declared a spread bet not a financial product.
Interesting.
So it comes back to, really importantly, the necessary financial purpose. And ASIC was careful to say in that report 506, this was a limited exemption based on limited information given to them. So that sets two boundaries. The first boundary being to the wagering companies, don't move into financial products.
Yep.
The second boundary saying, if it's got a financial purpose, we're going to relook at it.
Okay.
So at the moment, if you look at sport back 100 years ago, people were sort of doing their job as a welder and then they go and play football that night. Teams were trying to, now this is $1 trillion global industry. There's stadiums that cost billions of dollars, teams that cost billions of dollars. There's so many outcomes, merchandise. It's $1 trillion industry. And even, if you look at a game to the EPL, if you look at Tottenham at the moment, and I think they won last night, so they're probably safe. But if they get relegated, it's estimated to cost them £220 million per year on year. Wow. So if you're a sponsor, if you're an owner, you need these, sports not what it used to be. Sports not a joke anymore.
It's a business.
Yeah, players are paid tens of millions of dollars. If you look at the NBA, player getting injured is a big thing. If your team gets into the Champions League, if your team gets into the NFL final, it's huge. So you want to, if you're playing cricket and the whole thing gets rained out, but you're supplying merch, if your team's staying in a hotel and now you're 5 days, you've got to change all your, there is economic purpose in sports now. So I think that's going to be something that's going to be topical in that, is it appropriate for sports not to be on a financial market or some aspect of it, for example, because if it's what they like to do is say it's an athletic event. So if you and I are competing at high jump, we might say that's an athletic event. But if but if you're looking at the World Cup, you look at the EPL, you're looking at any huge sporting organization, they're charging $150 for tickets to go from Manhattan apparently to some stadium. Now, what if you can't go? Like, there's all sorts of reasons why people might want to use a event contract for economic purpose. So I think that's going to be a hard one to navigate.
Okay. Where there's a line, it is very blurry and stuff there, but I think it's good to where things can become clear is because of all this experience we've had with traditional markets and stuff. And just going back to 761D, irrespective of it, and this is some homework here that we've done, will not any AML prediction market operator or wagering operator still fall foul of the binary options prohibition 1023D order?
That's another good question. So 1023D is the order to prohibit offering binary options to retail traders. But the definition of a binary option is OTC.
Okay.
It's over the counter, which means that it's not traded on a licensed financial market. The options are issuer issued, which means it's a bilateral relationship between the issuer and the retail person. There's no central order book, so you can't really get out of your they'll probably offer you spread. But the most important thing there, and this is really important for 123D, because ASIC just didn't sort of make this prohibition. They didn't just decide in a one-day meeting we're going to prohibit these things. This is a result of a combination of actions that have been going way back to 2015 in Europe, which had ESMA, FCA, IOSCO, all looking at these binary options at retail and looking at the nature of them and looking at the loss rate, the mathematical loss rate of retail. The biggest thing in a binary option when it's issue responsive is an inbuilt loss. It's exactly the same as wagering. So if you understand fixed price wagering, they might give you a 190 fixed odds.
Sure.
That means that as time approaches infinity, you're going to lose all your money, because even if you win. So the big problem with binary options isn't the fact that clients don't understand them. Because the same thing in wagering. You are entering into a trade that you are already poisoned by 15 to 30% loss inbuilt into it. So that's what they didn't like about it.
Yeah, interesting.
And both ASIC and the FCA did extensive mathematical probability, and they'd say, well, what happens in 40 trades if there's this sort of loss ratio, and they just kept concluding that everyone's just going to always lose their money. And that's where the prohibition came from. So that's why ASIC didn't necessarily adopt it, but sort of also was a believer in that. So it's not about trading a derivative on a licensed market. It's about when the product is issued by, because there's all sorts of conflicts, because if it's issued by a CFD provider, for example, the CFD provider is incentivized for the retail client to lose money. They have to. Same with the wagering company. You're taking the other side. You are competing against your client.
It's not a charity.
It's a battle between your client and you. In a central order book licensed market, the clients are trading against each other.
Yeah, there you go.
It's a zero-sum game, loss or. So if you've got a village of 100 people, and there's a central bookmaker, at the end of the year, there's probably going to be no money left in the village. The 100 people it's all been extracted by the operator. If you've got a central order book and those 100 people in the village are trading against each other, yes, at the end of the year, Billy, Mary, and Ann might have more money than Johnny and Bill, but all that money's still left in the community of 100 people. Obviously less the broker. So it's
the provider service.
So ASIC is no regulator is saying that people shouldn't have free will and you're not smart enough. But what they're saying is that when we come across a product that's so against you, we're gonna look at that product. And it happens all the time. You would have seen when gold and silver were roaring a couple of months ago. You go up to marketplace, and these poor people, if you look at the bid offer spread, if you look how terrible it is, they're paying 10% bid offer spread. 10%.
Ridiculous.
It's just so it's this idea of we're gonna harvest the retail trader by making sure they can't make money.
It's opportune money.
That's a problem with binary options. Now the thing is that that's exactly what a gambling operator does. It's exactly what they do. But again, they're protected by the fact that ASIC back in 2016 said that if it doesn't have economic purpose, then it's not a financial product, and therefore they're not caught under the binary option prohibition. So they're saved by that. And the financial markets, the regulated market, are saved by the fact that they're not taking the other side, so they're not issuing the product. There's a central order book where people could trade with each other. They're licensed. You need to have a license to run the market. You need to have a license to deal in the market. And there's all sorts of protections for the person against conflicts and all sorts of things. But it's primarily when it's a listed product on a licensed exchange, there is no inbuilt loss because you're coming to a central order book. That's the big difference. So it makes it far, far more fair for the retail.
I think that's really key. People need to understand this because it sounds the same. The punter, part of the pun, that they would probably think it's the same thing when the mechanics are not. And whether it's calcium poly market or whether it's what we call here versus the unfair type of market, this sounds a whole lot better. And speaking of, unfairness. I think there's a topic around, there's an area that needs to be considered here, which is AML.
Yep.
How does AML play a part in this, and why is that like better for consumers?
Do you mean anti-money laundering?
Yeah,
Do you mean Australian market license?
Well,
they're both AMLs.
Yeah, that's true.
So you mean Australian market
I
license?
do. Yeah.
Okay. There's over 100 years of learning and global experience in running a financial market. There are so many controls, and there are so many things we have to do to run a market. I could probably list off 150 different things just off the top of my head.
We'll do that for another episode.
Yeah, things that we have to do, but they're just extraordinary. The extent of the regulation, even to the extent of having reporting straight into the regulator daily position. If you look at insider trading, we've got position limits. We've got all sorts of things. We've got geographical position where trades come in. We have so much experience in chasing illegal and market manipulation. We have circuit breakers. We have disaster recovery sites. We have an obligation to have the technology right. So in our business, for example, at FEX, we have three different operating markets. We have a disaster recovery site. We have everything. We've got a rollover system that there can't be any downtime. We've got data security. We've got client segregated accounts. We have the broker, the FCM or the broker doing KYC and other work to protect the client and to allow the client to do certain things. We have ASIC, the regulator, and the RBA looking over products that you might list. There are so many. There's a whole thing of market integrity rules that I've got here. There's a whole Corporation Act that regulates how we can operate a market. So it's not about prediction markets. It's a market structure that these things are being offered on. That's the difference. It's not a prediction market argument, because you can trade BHP with 1 minute before expiry. It's a short dated option. Yeah. That's what you're trading, short dated and you can do it on leverage. Well, these are fully collateralized. So there's for the retail person to trade them, I think it's far simpler than anything else they're doing. And if you look at, say, your parents with a kid and the kid's trading meme coins, I'd rather the kid be trading the RBA. At least they might learn about the RBA. Then they might start chatting about the RBA, or they might learn about something that's maybe a little bit more relevant. So I think that the product itself is phenomenal. The market structure is where all the argument is. And where sports lies.
How do we, like, there's insider trading, there's ethics issues, there's things like that we've seen from what goes on overseas with prediction markets. How do we think about mitigations for those risks?
Well, they've amplified it because it's exciting to hear about. A soldier comes in. It's an exciting story. You could do a whole movie about it. It's incredibly interesting. But if you look at insider trading in traditional markets, there's rules. You can't even, if you're an ASX listed, a director can barely trade except in a certain window.
People that work for those companies.
Correct. So they've already self-regulated. So it's blown up because it's really, really interesting. But I think it's easily mitigated by all the controls within market structures. And if you look to which I mentioned before, the listing of immoral contracts, that's easily, we already, as I said before, we could not go to ASIC and list a physically delivered enriched uranium contract. Quite obviously, I'm using a stupid example, but they're not going to list, we couldn't list a contract for anything physically deliverable, ATCAMs or any sort of military type stuff. So it's already embedded in the traditional financial markets that you can't do stuff like that.
So prediction markets just does not equal a free-for-all Wild West if we're doing it in this structured way.
Absolutely. And firstly, you'd be constrained by your own organization having an ethics position. You'd be constrained by the ASIC not allowing you to list it. You'd be constrained by the government of the day also having an issue with it. So both those things are just, I think, they've been amplified because they're really interesting to talk about, but they're easily mitigated.
So you're saying that there's probably far more protections than people really understand or think?
There's so many protections. Okay. So if you compare an AML or a licensed market or a DCM, DCO model in the US, and you compare that even to a CFD provider, a wagering company, anybody else who's offering, even people don't even understand how an ETF is built.
Yeah.
People just think, oh, I'm trade. They don't know what goes on inside an ETF, the market making. There are so many things that can go wrong within an ETF. They're taking out home loans, highly leveraged home, which is probably the most sophisticated financial product.
Yep.
It's a mortgage. Somebody can take your home. You've got leverage like you couldn't believe, sometimes 90, 95%. People don't know the first thing about a yield curve, or it's such a complex. You should have to do a 3-month course before you're even. And I'm not joking. Before you take out a mortgage. So right now, people are taking out these very complex finance, and there's a whole cheer squad.
Yeah.
So you've got asset cracking down on influencers. What about cracking on a real estate influencers, or whatever they call? Because there's a whole chain of people encouraging people who don't understand what they're doing to take on, to get on into this market on the ladder.
There's the structure around it to protect people. So
what's the structure that protects people in real estate?
Well, there's better structure than just like buying anything just off the street is what I'm saying. So
for a mortgage, well, I'd argue front up with your deposit, and you can prove you can supposedly pay for it, you're going to get a loan.
Yeah, that's true.
Whereas these prediction markets, to be able to trade to onboard with the FCM or the broker, it is the onboarding process still does require some, and then even then the FCM or the broker can restrict if they think you're not capable. They might say, okay, we'll let you do this, Mark, but you can only trade A and B. And I think prediction markets would be the one they would allow people to trade. No margin, no leverage.
There's an outcome.
Yeah, there's a definite outcome, and they allow small contract sizes.
Yeah.
So people aren't getting, a margin call for $150,000 and going broke.
Do you think there's part technology that's really helped with this? Like being where we're at in the world with technology and the electronification of markets,
absolutely,
that helped as well.
Help in what way do you mean?
But make this prediction market something that
absolutely
can do now.
Yeah. Yes, because if you take a wagering example back again, people went to the track and they had a board. You go back to the stock market days, so there's chalkboard up there. You're getting a phone call.
Right.
When we're way back in the 80s, the information flow from up the floor into the thing it took sometimes hours. Margin calls could take days. We would sometimes pay margin calls 6 or 7 days later.
Wow.
They had no control over our money. The whole thing, you could trade on margin with nothing in your account. None of that can be done now. And people can access their accounts on their device. So, and people have a right to, they've got a right to freedom of what they feel they want to do with their money and with their time. The obligation in my opinion, of the regulators is to make sure it's a level playing field. To make sure these people. But if you look at, say you're running a potato market, and you're a farmer and you're a restaurant, and there's a middleman in there, you go to the local market, the restaurant has to pay $5 for potatoes, the farmer sells at $2. Now, in a central limit order book, in a market, the farmer and restaurant guy probably settle at $3.50. So there's not this massive take all the time from the retail people. The idea is to make the retail, give them a safe, level, fair place to do their financial activities.
They've got a seat at the fairer table as opposed to the more unfair tables that it seems like they've been accustomed to and just haven't known.
Well, accustomed to is a good way of putting it. So they just accept. So people going to buy their gold down in Martin Place down here, they didn't even bother looking on the website saying, I'm going to pay, $5,300, but you're only going to pay me $4,600. It's incredible. And people don't really sort of understand that. So I think that the good thing about a central limit order book is that there is no inbuilt loss immediately put onto the retail. It makes it mathematically impossible for them to make money over time. The other thing in a prediction market, you don't have the inducements you don't have the inducements that you get that people are trying to gamify wagering all the time. So can I get this? Can I go? A prediction market, you're just like the exchanges.
Oh, that's interesting.
Sort of like a utility.
You
don't call the exchange about getting a bonus, or you just do your trade and
that's it.
It comes through a whole established network of reporting.
Because of how it works currently, they have to induce because they need that business.
Correct.
That's an interesting way to look at it.
Correct.
Okay. I mean, you talked about the central limit order book model. You seem to favor that. Where do you think things will head? What's the the next
in Australia?
Yeah.
Okay,
how do you think this evolves?
How I think it should evolve,
Yeah, please.
and how it will evolve might be two different things, because in the end, Australia is a country of a lot of oligopolies and monopolies. So there's a lot of power in certain companies here. So certain companies can sort of get better traction in their business model than they might get in somewhere like where there's a larger market and more sort of, I guess, anti-oligopoly, anti-monopoly sort of rules. But here, how it should be quite clearly is that, and ASIC have sort of looked at this in 2010 and 2016, wagering and gambling should be on products that don't have a financial purpose. The whole idea was you're going to have a bit of fun. You're having a bit of a punt. It's all fun. You can't complain that the settlement price is wrong. You might complain, but in the end, but if you're wanting to trade something really important with economic purpose, I think it has to be on a licensed market. And I think the place for them to be, obviously, is markets that have 150 years of learning and 150 years worth of solving problems. And 150 years worth of all the learning, all the problems that were going on, how to solve all the insider trading, market manipulation, settling of markets, all the things that we've learned are appropriate for the market structure. So again, prediction markets are nothing new. They're just simple derivatives. They're much simpler than derivatives we did back in the 80s. They're very simple. It's the market structure. That's what the big fight's about. Where are these going to settle? Are they going to settle with wagering companies in the US, with the States? Are they going to settle on DCMs? Are they going to settle on crypto, offshore crypto exchange? So Australia, there's two places they can go under the Interactive Gaming Act on a state-based license, or in an Australian market license, ASIC issued market license. Okay. So I think they should be, if it's got economic purpose, they should be on a licensed market. And whether I think they should exist at all, the first thing people are going to say, well, it's gambling, it's gambling, it's gambling, it's gambling. Everything's gambling. And what is wrong with a homeowner with a mortgage wanting to have an outcome based on an RBA move, which directly affects him? What is wrong with somebody who's selling merchandise at the Easter show, who's worried about it's going to rain for 7 days, and they're buying all this inventory that they might not be able to sell? What is wrong with somebody with a prestige car who never takes it outside, who doesn't want to get hail insurance for a year, who might just want insurance for 4 days while doing his concourse? What is wrong with people being more sophisticated? I guess that's a pun and options, but what's wrong with people being able to, and what's wrong for an election, for example? If you're if you feel that or a referendum, if you feel you have a really strong view, why shouldn't you be allowed to monetize that view? Because you spent all this time learning and researching. Why shouldn't you be able to somehow gain benefit from doing that? So I think the idea of the prediction markets, it's a great idea, particularly for retail, because it's so simple.
I would say there's no choice to do that at the moment here in Australia, but by bringing this in, there will be a choice, and not just a choice, but a fairer choice.
What do you mean by that?
To be able to bet on these things that to have a punt on these.
See, and I know that I know Ben punt. We say trade, because that's like saying I'm having a punt on BHP. People don't. It's not a punt on BHP. I don't think it is anyway. It's not punt getting a mortgage. It's a punt. My Fair Lady and Race 8. That's a punt. That's a fun punt. But anything else is a trade. You're taking it. You're trying to research an outcome and financially benefit from doing that because you think you've got superior knowledge. The other thing that they do accidentally, these prediction markets, is they amalgamate information. So they become sources of information. I think before.
Well, I just on the source of information, the wisdom of the crowd.
Correct.
So it's been proven in so many other places. Like I've been a fan of a product called Estimize, which wisdom of the crowds help better than Wall Street. Deutsche Bank wrote research on this. It had better results on predicting whether companies were going to hit or miss on revenues and margins than Wall Street analysts. So there is a power to the wisdom of the crowds that plays a part.
Absolutely, because right now you don't get your voice heard. So if you look at the yes/no referendum here, the media and the spending on it made it really look like there's going to be one outcome. But people really thinking about it knew there was going to be a bit of a different outcome. if you're looking at different elections and people say, well, a prediction market on an election, well, I should have finance involved in it. Finance is already involved in it.
Yeah.
When Trump got firstly elected, surprisingly in 2016, the Dow went down 1,000 points. The markets are linked to the government already. They're linked to elections. So if you get a party in that's in favor of, if your election's coming up and one party says they're going to do something to capital gains, or they're going to do something to capital gains tax, or there's going to be a economic outcome on property you might own. If the tax rate is going to go up, if it's going to go down, you might want to defer some tax.
Yeah.
You might want to do, so everything the government does, or the government of the day does, or plans to do, has an economic purpose or result to it.
Yeah.
So an election is really economically important for people. So why shouldn't they be able to hedge themselves on an election
in a fair
or
way.
use their superior knowledge?
Yeah.
Secondly, instead of the other thing about people say, well, that means a really rich person could come and place a huge bet on a certain party. Well, the good thing about a central order book is then other people can come in and say, well, good for you, you're trying to manipulate the market, but thank you, I'll do a trade against you on that. Second thing is we obviously have position limits. So somebody couldn't take 100% of all the position. We'd say, okay, Mr. Barnes, you've done this and you can only do this much. And we also will disclose that person.
Yeah.
It's a big side of it. So everybody knows and go, okay, that's them. That'll encourage people to take the other side of it. So elections are already inextricably bound to the economy and financial purpose. Everything a new party gets in, if you're going to cut immigration, if you're going to cut education spending, whatever you're going to do has a point of it. If you're going to increase R&D, change the R&D rules, then you might want to, if you're getting R&D grants at the moment, and for example, they've just cut wagering of R&D grants. If you had a prediction market on doing that as a wagering company, you would have been able to hedge that outcome. So elections are extraordinarily important for the economy. So why can't people work on that? A desalination plant, something happening, affects everybody in some way.
It sounds fair. It sounds like better choices for people right now. Do you have, as we round out, some final words that you want to share with the audience here?
I think the most important thing is to keep the market structure and the idea of a prediction market separate. So immediately people are going to say, we don't need more gambling, we don't need more gambling, What is gambling? Is the problem with gambling the fact that there's an inbuilt loss to the person? Is that why everybody's so against it?
Yeah.
Is that the reason why? Because everybody's going to lose their money over time? Maybe that's a problem with gambling. Not the problem with people having the opportunity, because there doesn't seem to be any ban on advertising for people to invest in an ASX listed company. There's no anti-advert. People can put ads in the paper saying you should buy our company. Well, you could arguably say that this person knows nothing about how to, say, turn spodumene into, some rare earth, but they're investing in the company because someone's marketed to them.
And the markets have been growing. ETF markets are
ETFs. I can't tell you how many times I've heard someone say, I'm going to invest in ETFs. And I'll say, well, which ETF? Well, I just want to invest in ETFs. They don't even know what an ETF even is.
Look under the hood.
They don't know what it is. So a prediction market is, so just remember the market structure. So that's the takeaway I'd like people. It's a market structure that's the issue. So if you want to talk about ethics, if you want to talk about insider trading, if you want to talk about inbuilt losses, talk about the market structure. Think about the market structure and where that should lie, what's more fair for the retail client.
I think that's a really good way to look at it for overall markets, and just being able to see these things laid out as you've described. I think there's a lot of learnings people will have had here. So it sounds like there's going to be some interesting times for prediction markets. I can't wait to see what happens next.
The big fight sport. So that's a one to watch, what's going to happen with that.
Well, we love our sport here at Australia, so there's going to be a lot that we'll see, I'm sure. Brian, thank you so much for your time.
Thanks, Mark.